Hey everybody, wanted to make this video. Um, as many of you know, I'm always on the lookout for ways for people with no money or with small amounts of money to trade. And, um, you know, that's our biggest problem as traders is, how do we get funding? And lately there's been a slew of different challenges and courses that come up, and I ran across this one, Earn to Trade. It's called the Gauntlet Mini, and it's really kind of cool. Basically, they'll give you $150,000, and you can trade up to 15 contracts, and at a $350 fee. So candidates must adhere to a disciplined trading plan that incorporates. By the way, stick with this video because I'm going to show you how a trading method that you can use right away to take this challenge. Candidates must adhere to a disciplined trading plan that incorporates the following rules. It is important to note that any deviation from the rules will result in termination of the Gauntlet Mini and force a restart of the program. Trade a minimum of 15 days. Do not reach or dip below the daily loss. Do not exceed the maximum position size. Do not reach or dip below the trailing drawdown. I have to know what that is. Only trade during approved times. Maintain consistency. So if we look at this program, you have to make $9,000, which is not unreasonable. Yeah, it's about 8%, which with a 150K account, which is not bad. You can't have a bigger drawdown bigger than $4,500, and the most you can lose is your daily loss limit of 3,300. So those rules are not that sticky, right? That's not that sticky. So let's just click on this. Let's see if we can get some more testimonials. I don't know exactly what that trailing stop means. Trailing drawdown 4,500. Let's see what that means. See if we can find out exactly what that means. More. Trade. Well, we'll get to that later on. But anyways, I'm going to show you teach you a little method right now that I used for years, trading the ES, okay, or in this case the SPY. So what we have here is we have on the left hand side we have the SPY on a 1-minute chart. We have the advanced decliners on the right hand chart. Now, in order to trade properly, you do have to understand how order flow works, and you have to understand things like value, you have to understand pressing limits, you have to understand how liquidity plays a big role. But a very simple method that you can start to use in this challenge would be just a simple scalping method. So let's go through some examples here and see how you could take this challenge using the internals of the advancers versus decliners. By the way, if you don't know what that is, that's basically the breadth of the market. So when you see a reading, and the key thing to remember with the advancers and decliners, always mark off to 0, because it's whether it's above or below 0 that matters, not the actual chart itself. That's really, really, really key. So if we started this day here, we would see that the advanced decliners opened above 0, which means that more stocks were advancing than declining. So we would expect the SPY to be higher as well too. Now, how much more? 1140. Okay, now these numbers will mean something because you can see they go pretty high, but if we look at just like a 15-minute here, you'll see they don't really range too much outside of 2000, right? 2500's high, negative 2600's low. So you got to keep that in mind, okay? In relationship, right? In relationship. So let's just go back to a 1 minute. Okay. Okay. So on this particular day, the advancers and decliners are up 1,000. Remember, 2,500's really high. So we would expect the SPY to be up quite a bit. You know, if you take a look at the average move of the SPY, let me just take a quick look and show you that right now. Okay guys, so I updated the data here. This is 1 year of the S&P 500. Now I've asked the spreadsheet to tell me how many times does it move from 0 to negative 0.4 all the way up to 2, right? Could probably adjust this. Anyways, this is what we get. We get a frequency distribution that looks like that. So over the last year, you can see it's been slightly on the upside, right? But you can see that I probably want to adjust this data a little bit. I want to see, let's do this, let's do negative 0.5, negative 0.75, negative 1, let's do negative 2, negative 2, negative 2.5, 0.5, oh, shoot, 0.5, 7.5, 1, we'll make this 2, and we'll go 2.5. Okay, so let's just take a look at that. Okay, that looks a little better, right? So what we can see here is that the vast majority of time the market is staying between a 0.5 range and a negative 0.5 range. 0 to 0.5 and 0 to negative 0.5. And really, I would say that 80% of the volume, if not 88%, is between negative 2 and positive 2. So a 2% move is a big move on this asset, okay? And we want to know that. So when we go back to our chart and we see the advanced decliners that are up almost 1,200%, or sorry, 1,200, and we know 2,500 is very high, we would expect this market, when it opens up, to be up at least 0.5%, right? At least 0.5%, if not more. So let's see where this market does open up. And you can see it opens up very small, 0.16%. This is suggesting to me that the internals are much stronger than the actual futures. So I want to be long this market almost right away, okay? as you can see, the market catches up very quickly with the internals. Okay? Now, when the internals make a new high here at 955, you would definitely expect the market to be making a new high. And as you can see, it quickly does. And as the internals keep making new highs, you would expect the market to keep making new highs. And that's exactly what happened. Okay? Even right to the end of the day. Okay? Now you can also use this on other stocks if you want to. But let's take another example. Let's go to the day before. So here we have advancers, decliners. Now I know it looks like there's a big gap down, but there really isn't. This market actually opened up stronger. That's why you always got to keep that zero line there, okay? So on this day, the market was really high in the close, but it actually was high as well too in the advancers decliners. So when the market opens up at 914, we would expect the market to be higher as well too. Okay? So let's see what happens. The market's lower. So we would want to be buying this market. Now, where you buy, well, that's something that I highly recommend that you head on over and take my order flow class, because it will help you tell you where you buy. But we want to be buying. We can see that after the first minute on the internals, we're still high. We definitely want to be buying. The market goes lower, internals go lower, market goes lower still, internals come down, market goes much lower, internals get much lower, market finds a bottom here, and the internals find a bottom, but they're still high. So we want to be buying. So my students will recognize this as a good opportunity to be looking for longs, okay? Now, do you just use one candle structure? I would not. For my students, I would use some type of pressing limit. So let's wait till we get that. We don't get one yet. Boom. Okay. So now we can see that the market is all the stocks in the market that were advancing 900 have now filled those gaps. And now it's an even number of longs and shorts, advancers versus decliners, okay? But the market itself is still very weak. We definitely want to be buying in this opportunity. Now, my students will see that we picked up a little bit of liquidity right here. So this would be an area where I'd be very interested in looking for a long, okay? Because the market is still way down and the internals are neutral. So the internals are still stronger than the overall market. Okay. If we clear this high, I'd be looking for a long here. Boom. All right. So now I'm long. Where do you get out? Well, we kind of have to play that candle by candle. So we can see that the internals actually went lower, right? They're catching up. So we see the market made a new low here, internals made a new low, market made a new low here, internals made a new low, and now the internals made a new low, but we're expecting the market to go higher. So that means I do not want to be too aggressive with this trade, and I want to be, making sure I cover my trade very quickly if it doesn't work. Okay, so now we see that the market is finding a bottom. And the internals are bouncing a little bit too. Okay? Boom, you get smacked and you're stopped out. Looked okay for a little while, right? Looked okay for a little while. But the market has now made a new low. And the internals have not. They've made a higher high. So I still think you can buy this market, right? But again, you just got to be really fast, and you got to realize that, um, that it's a scalp. You're not holding on to this trade for a long time. Okay, so you get the bounce off of that liquidity level, right? Now at this point in time, we notice something interesting. The market made a swing high here, but the internals did not. Do you see that? This is suggesting to me that you definitely want to get out of this trade, right? That's it. That's all you're going to get on this trade. And you could have known that when the market made that high right there, at swing high, and the internals did not make a high. That's it. Take your profits. That's it. It's just a short scalp. And as you can see, it gets pretty messy here. So now we make a new high here. And the internals are still really weak. Do you see that? They're not really weak. In reality, again, you got to put this in context. Look at the zero line. Okay? In context, the market is still weaker than the internals. You see that? The internals are actually up on the day, and the market's down on the day. That's why we wanted to buy in this situation. Now you might say, Steve, well, you covered your trade there. You could have made more money. Yeah, I could have made more money, right? Here, the market is actually almost even, and the internals are slightly higher. So the market is still lagging the internals. And finally, it catches up. Okay? So we had the right idea, right? The right idea was to buy liquidity off the low because there was a deviation, or there was a difference between the two. Just like that. That's all it takes. Let's go to the next day. Okay, so the next day, the internals open up down 0.27, right? So we would expect the market on the previous day to be down as well too. Remember, always do that red line. It'll really help you. So everything is congruent, isn't it? The market's down, the internals are down. There's no There's no edge here, is there? There's really no edge. So you really can't really do much here. You could watch for a little while. Maybe an edge will develop. So the market shoots up really strong. What happens with the internals? They shoot up really strong too. They follow the market. So there's no edge at all. Okay, this is interesting. Notice here that the internals make a new high, but the market does not make a new high. This is suggesting to me that we want to be long. Now also, let's look at the raw numbers. The internals here are at 1367, okay? Which means the market should be up at least, if we go back to our frequency distribution chart, the market should be up somewhere between at least 0.5% and 0.7%. So let's see if it is up at least that. No, it's not. It's got room to go. Does that make sense? It's got a lot of room to go. Remember, it's the raw number that's important. So let's find a long. Now my students will see we just picked up some value right here. And this could be turning into aggressive value. Let's get long. Always compare. Now we're up more like what we were expecting, 50 to 70%, right? Now we're getting closer to where we should be. The market makes a new high, the internals make a new high. Hold your trade. New high. New high. New high. Now notice something interesting here. The market makes a new high, and that's pretty in line, right? But I would probably be locking in some profits right now. Definitely locking in some profits, okay? Now, as the market makes this new high here, let's look at what the internals are doing. Especially on that candle right there. So the internals do not make a new high. Now this is a place where I would not look for a short, but I would definitely take profits. 100% I'd be out of my trade. I would not short there. Okay? And the main reason I would not short is because of relativity, meaning that with the internals at 1800, remember 2500 is high, I would expect the market to be up anywhere between 1% to 1.5%. If we look at our frequency distribution curve again, that looks about right, right? We could even put some more numbers in here, right? We could even, like, you know, figure this out a little bit better and spread this out a little bit more, but for now let's just leave it. So this is what we would expect. We would expect the market at 1700, just think of this as 2500. So if that's 2500 and we're at 17, we expect the market to be somewhere around, maybe as high as 1.7, 1 point or 2%, 1.5%, something like that. It's got room to go, right? This can still go. We're only up 0.63% here. See what I'm saying? It's like really important you look at the raw numbers. This has room to go. So I might have locked in some profit here. Now my students, my order flow students, will know this is great value down here right at this liquidity level. Take some profits, get back in, look to take out the high. Boom. Again, we make a new high here. And the internals are holding up. You can see the internals are not coming down. So I would definitely not be shorting this market, and I might even be holding on to my trade or holding on to the position that I added here. And there we go. See that? See how the market caught up at the end of the day to match the internals? Pretty cool, eh, guys? So this is just going to be a little introductory video. I'm going to do one more day here just to give you an idea. Okay, so here's the 19th. Okay. Okay. So on this day, the market, the internals open up negative 339. So we would expect the market to be down slightly on the open as well too. Let's see what happens, and sure enough, the market is down slightly, right? Now, how much is the market down? The market opened up 0.32% down. That seems relatively in line, right? We're at negative 0.4. That might be a little bit too high. There might be a small bounce here, and that's exactly what we get. So there's nothing to exploit in this situation. Now, what's really important when there's nothing to exploit is always pay attention when new lows or new highs are being made. As you can see here, we make a new low right there. And we would expect the internals to make a new low. And they do. So, right now, the only real edge is that the market's weak, and it's probably going to stay weak unless the internals get strong. So, the only edge that you could really come up with is, maybe selling any pops higher, assuming the internals don't adjust. Keep going lower. Internals keep going lower. So again, the only edge we have is to follow the strength of the market. This market is not going to bounce. It's only going to get weaker. So sell into any pops. Now, let's ask ourselves the question, how low is the market and where are the internals? So market is down 0.87%, which according to our frequency distribution chart, somewhere in here. So we're getting close to, where we should be. We should probably be breaking this down a little bit more. We should probably have 0.5, 0.75, 1, 1.5, 2, 2.5. Well, we could probably do that right now. So we should have 0.5, 0.75, 1. Let's change this to 1.5. And then we'll just say greater than 2. I would probably add another column here. So it should be negative 1.5 and negative 2. Oh, shoot. Negative 2. Okay. That's a little bit more representative, right? So we know that there's only 11 days the market moved lower than 2%, and only 8 days the market moved higher than 2%. So here we're down almost 0.87%, right? Okay. And this is down 15. Remember, negative 25 is an extreme. So we're about right. Market should be down about 1% in relationship to the advanced decline line. So we might go a little lower. There we go. That's about right. So now we're in alignment, we're in congruency, and you can see right from the very beginning we knew we should not be buying that market, and we knew why we should not be buying that market, right? Nice day. At this point here, the market would be almost exactly where we would expect it to be, which is down 1.12%. And we know, looking at the frequency distribution, that's within the acceptable range, right? That's what we would expect. We would expect it to be down somewhere there with the advanced decliners being at negative 1500. Make sense? Okay. So all you had to do is just get short on that day. One more. We'll do one more. That's it. Okay. 16th. These are the ones I really like. These are the days that are beautiful. I'm glad we're doing one more. Now, we see the internals open up negative 0.27, but the market is up 0.35%. This is just an easy fade right out of the gate. Okay, the futures have gotten farther than the internals of all the stocks. Easy fade right out of the gate. Now that doesn't mean that the internals can't turn and go higher, so you don't want to be like super aggressive about it. You do want to be shorting it though, right? Okay. Okay. So we can see that the internals got really weak all the way down to 0.8. Wait, am I on the right day? No, sorry. Forgive me. Wrong day. My bad. Messed that up. Start from scratch. Okay. 0. The internals open up really strong. Really strong. Okay? And we are up. But we're not up that much. So again, we have to start all over from scratch. Forget what I said previously. We want to be looking for longs. Now my students, I'd probably look for a pressing limit before I got long. Let's see what happens. Okay. So the market refuses to go higher and actually makes a new low. Refuses to go higher and makes a new low. The internals are still up 600, so we definitely want to be looking for longs still, right? But not that aggressively. Let's see, right now we're up. Yeah, we're up 23%. It's about right. This should be, we should be up about 30% with the internals at 658. 0.3%, sorry. So we definitely want to be looking for longs. Okay, I would wait for a pressing limit. My students will understand that. Okay. Okay, now you can see, like I told you, sometimes it's the tail wagging the dog, and sometimes you got to be aware of that. Sometimes the futures will drag down the rest of the market, but most of the time the overall market sentiment will be strong. Okay? So you can see here we're almost at 0 and we're almost at 0. So things didn't get really too far out of whack. We definitely wanted to be looking for longs, and that's why don't use a candle structure, okay? You've got to use a pressing limit in order to get into this, okay? Okay. So now we're congruent. There's no edge anywhere, right? The internals opened up strong, but immediately they sold off. That's why you can't just jump into the market. You have to understand a little bit about reading the order flow and structure without just jumping in. Look at that bounce off of that open. Wow. We knew we wanted to be long, right? Now look at this. Isn't this interesting? We had a big bounce off of even, and the internals do not follow that aggressively. So I think we might be able to get a short. Let's see how high we're up. 0.26, and we're up 1.25, right? Oh, hold on a second. Oh, look at that. Look where we are. I think we could definitely find a short here. See how we're right there? I think we could definitely find a short scalp. Done, just like that. That's all you need. Maybe a retest of this level at the very most. Okay. That's it. That's all you needed to do. Right? That's a short little scalp. Now, you want to be paying attention. The internals make a new high here at versus this swing right here. So I'm leaning towards the long side still. The internals at 312 and the market is up 0.21. That's about right. That's about right. So I don't see any real edge. And you can see the market's just kind of chopping around here. You're looking for big variances, right? Big variances. The internals make a new high right there. A swing high anyways. But the market does not make a swing high. So there you go. That little short there took a little while to play out, but ultimately it worked. You know, would I have reshorted again? I don't know. I actually, when I was thinking about this short here, I was thinking maybe test this little breakout level here. That's what I was thinking. And you can see it just turns into a chop fest, right? But there's congruency. And all you're really doing when this type of market happens, you just really want to pay attention to the swing high. So when we get back up at the swing high, we would expect the internals to be back up around that swing high as well too. Let's see if they are. Because this is where the real edge comes in. So we're back at that swing high at 14:05 in the afternoon. Around there. So we can see there's a bit of incongruency, isn't there? So this is another good little scalp trade right here, right? You can lean against that. I'd wait for a pressing limit or some type of really strong rejection candle. Okay, that's a liquidity grab. That's just a stop run. So now if we can get back inside this range, if we can get back inside that range, we should test the other side. Okay, there's my pressing limit right there. So I'd get short here. fun. Now as the market keeps pressing higher, this is what happens when you trade the S&P 500, by the way. It's never easy. It's always hard. I still think we're good because the market right now is up 0.32. It's not a big difference, right? But I would expect this to be up around 400, 500 relatively. So maybe you get stopped out there. Maybe you hold on to it for a little longer. I think either one is fine. Now I'd be really, something is changing, right? The market keeps going higher. Now, again, this is not, it seems like it's a bad thing, right? But there's opportunity here. There's opportunity here. All this is algos firing. And the algos are basically squeezing off orders and running me. They knew I shorted this level and they squeezed me out. More shorts came in. They're squeezing them out. They're squeezing them out. They're squeezing them out. I would not expect this to hold though. Right? Would not expect that to hold. I'd expect us to come down at some point in time. Now, it keeps going higher. Just squeezing. This is just algos doing their thing. I told you it's going to come down at some point in time. And ultimately it did, right? But not before it squeezed, 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 and squeezed once more by the close. Right? Now, one of the ways that I personally used to trade this strategy is not with futures. I used to trade it with options because I found that the options were far safer. Okay? In other words, if I would have taken an options trade short here, by the end of the day, I could have got out of that trade quite easily. So they're not always going to be perfect, right? You're not always going to have perfect trades and perfect situations because that's what makes a market. If something was really easy and it's something you could do all the time and it worked every single time, well, I wouldn't be making this video and selling courses for $1,000. If you like what you saw here and you want to learn how to read the order flow, head on over to my website. I might try this challenge, right, and give it a shot. Now, the difference with this challenge, you're going to be trading the E-mini, right? So you got to be careful because in a situation like this, that's a big mistake. That's going to cost you a lot of money, right? You knew it was going to come down at some point in time, but not before it finished squeezing. Right? You understand? And probably after hours it came down. You can see here, after hours it did come down. Now if you're trading the E-mini, the E-minis trade after hours, so but you would have gone through a lot of heat on that. That would have been an expensive ride trying to wait for that to come back down. That's why I say always use a hard stop. Okay guys, I hope you guys enjoyed that, and I'm glad we saw good as well as bad situations. Love you all. If you want to learn how to do this or how to read order flow like a master, please head over to my website and buy one of my services, my group mastery course, and you'll love it. You'll absolutely love it. Every one of these testimonials is real. Not all the pictures are real because people didn't want to, not everybody wanted to give their picture, but every single one of these testimonials testimonials is 100% real. Nothing is fake, nothing is forged. Love you all. Bye for now.